I'm going to take a look at the metals and the dollar, I guess, today in this video. So far, things are playing out pretty much as I expected. Um, Silver, this is a chart of silver, and you can see this has been an exceptionally strong market. It took a few days here to get above the 200-day moving average. Once it did, it looks like it's ready to break away from that and continue higher. There really isn't much resistance in this chart until we get to about $19, and I'm fully expecting silver to make it to $20 or higher before this intermediate cycle tops. I suspect we'll see something similar in gold. We'll probably take a few attempts to get above the 200-day moving average here when it tags it. And then once it does, it'll probably break away like silver, and then there isn't going to be a lot of resistance until we reach the election night top here. So probably next week we're going to tag this 200-day moving average, and we may spend all week trying to get through that. But I'm pretty sure gold will follow. Will follow silver. It will get through the 200-day moving average. And then we'll probably have a pretty strong move up to my goal, or my thought has been that we're easily going to see 1300 plus in gold during this intermediate cycle. It has to break the intermediate trend line, so before this intermediate rally can top, it has to at least break this trend line. So we've got a lot of upside potential still in the metals market. Now I cautioned my readers last night not to read too much into a one-day move or underperformance in the mining stocks. You can see here the miners did not recover and hold this 200-day moving average yesterday. Many people viewed that as a warning that the metals were going to turn back down. Of course, as you could see in that last chart, that is not the case. You have to be careful of reading into a one-day move something significant. It could just be that buyers weren't ready to buy above the 200-day moving average here. It's possible that the banks are trying to hold price down so that they have more time to accumulate their positions. I've shown this before. Sometimes the miners lead and sometimes they don't. I showed this before the bear market bottomed with the miners making a lower low, and gold did not make a lower low here in January. This was just a case of big money of the banks pushing a price, shorting the miners heavily, trying to break this technical support so that they could scoop up all of the shares that the retail traders and the hedge funds were dumping on this technical break. And then once they had filled their positions, then the market was released to start the baby bull rally. So I think it's a mistake to read something into a one-day move. Sometimes all it means is that the banks are trying to accumulate positions ahead of the next big move, and that may be exactly what happened yesterday. Is the banks were just shorting the miners, trying to hold them down so that they could accumulate positions here at the bottom of the daily cycle. We re-entered our positions yesterday, and I'm fairly confident that we are in on day one of a new daily cycle. And in a bull market, the advancing phase of a daily cycle usually lasts 15 to up to 25 days, maybe even 30 days. This cycle here lasted over 30 days before topping. So I'm going to maintain my stance. I think the miners are going to at least test the summer highs before this intermediate cycle tops. And what we've seen is exactly what I predicted was going to happen. Human nature never changes. The people that bought this breakout, they either sold, on this. We saw a lot of bearish sentiment on this break of the 200-day moving average, which I suggested was probably going to happen. That we probably drop for a day or two below that 200-day moving average. This is where the people that bought the breakout, they got stopped out right here, and I suggested that was going to happen. That a move below the 200-day moving average would trigger stops on a lot of traders, and they would make the classic mistake of buying the breakout, selling the correction. As long as gold and silver continue up, and right now it looks like we've started a new daily cycle. There should be many days yet to go. So, what's probably going to happen is most of these traders bought the breakout, sold the correction, and now they'll wait for they're nervous. They took a loss in an upwards trending market. They'll be nervous, and they'll wait to buy a breakout again. So we'll probably get, I'm going to guess we'll get a nice move up to, there'll be some resistance right here, and then when we break through that resistance, then the next resistance zone will come here. So what they'll probably do is they'll buy the breakout above this. We'll hit this resistance zone at these September peaks, and then gold and silver will move down into a half cycle low, and the same pattern will repeat. They'll buy the breakout, they'll sell the correction, and then once the correction's over, then and we've caused these people to lose money again. These people that keep repeating this pattern, buying breakouts, selling corrections, then we'll probably get a pretty strong move into, I'm going to guess, the end of March, beginning of April, and we'll at least test these summer highs. And I think this is going to be the driver of that move in the metals, is that the dollar should have at least one more daily cycle down before it completes its yearly cycle low. It's kind of hard to see here, but you can see that the dollar is trying to break this cycle uptrend line today. Once that cycle uptrend line breaks, then we've got probably a day 8 top. That would be a left translated cycle. So I would guess that we're probably going to at least test the election night lows before this intermediate cycle were to bottom, and probably sometime in late March or early April. So that should drive the next leg up in the precious metals market.